You know that feeling when you're staring at a market chart and it just feels like chaos, like navigating a storm without a map? Well, today, we're going to build that map. We're creating a blueprint to move from that chaos to real clarity, giving you the tools to make smarter, more confident decisions. So let's be honest for a second. When you place a trade, does it sometimes feel like you're just guessing? Like you're just flipping a coin and hoping for the best? Look, that's a really common feeling. But the goal isn't to guess. It's to learn how to read the signs the market is giving you. And that's exactly what we're going to break down right now.
So the first thing we have to do is stop looking for that one single magic indicator. It doesn't exist, I promise. Instead, I want you to think of your indicators as a toolkit. And for what we're doing today, that toolkit has 3 essential items: a crowd meter, a fuel gauge, and a compass. Let's crack open this toolkit and see what's inside.
Okay, first up is volume. This is our crowd meter. It's so simple, but it is incredibly powerful. All volume tells us is how many people are actually participating in a price move. If you see high volume, that means the big players, the institutions, they're involved. That gives the move real conviction. But if you see low volume, that suggests there's not much interest and the move could just, well, fizzle out. And I love this quote because it just hits the nail on the head. A price that's breaking out to new highs, but the volume is low? That's all show and no substance. Yeah, the intention is there, but without the crowd, without that conviction, there's just no follow-through. It is a massive warning sign that the move might not be for real. All right, next tool in the box, the RSI, or Relative Strength Index. We're going to call this our fuel gauge. It basically measures how fast and how far the price has moved, on a simple scale from 0 to 100. When that needle gets above 70, it suggests the market is overbought. Maybe it's running out of gas. And when it's below 30, it's oversold and might be due for a bounce.
But, and this is a huge but, here's the pro tip you can't ignore. In a really powerful trend, like a rocket ship taking off, that RSI can stay overbought for a long time. So trying to short the market just because the fuel gauge looks hot, that's like trying to stop that rocket with your bare hands. It's not going to end well.
And our third and final tool is the moving average. This is our compass. Its job is to cut through all the chaotic day-to-day price noise and give you a single, clean line that shows you the underlying trend. Traders use different ones, like the 20, the 50, or the 200-day, as key signposts to figure out the short, medium, and long-term health of the market. And honestly, using this compass can be incredibly simple. Just ask yourself, is the price above the moving average? If yes, you've got a bullish bias. Things are looking up. Is the price below it? Well, that points to a bearish bias. This is your starting point, your fundamental orientation before you do anything else.
Okay, so we've got our compass, our fuel gauge, and our crowd meter. That's great. But the real power, the real secret sauce, isn't using these things by themselves. The magic happens when they all align, when they all start telling you the exact same story. And there's a word for that. It's confluence.
Confluence. This is the whole idea we're building towards. It's just a fancy word for agreement. It's when your compass, your fuel gauge, and your crowd meter are all pointing in the same direction. This is how you stop acting on a single signal and start building a strong, evidence-based case for a trade.
So let's paint a picture of what this actually looks like. Let's say we have a bullish setup. First, the trend. Price pulls back and perfectly touches a key support level, like the 50-day moving average. Our compass is still pointing north. Second, momentum. The RSI, our fuel gauge, dips down near oversold and then hooks back up. The tank is refilling. And third, conviction. Volume starts to pick up as buyers jump in. The crowd is getting on board, you see? Each tool is confirming the others. And this is the whole point. When you have that kind of confluence, you're no longer just hoping a trade works out. You're not guessing. You are systematically stacking pieces of evidence, one on top of the other, to build a high-probability case. You're shifting from gambling to a methodical process.
Okay, that's all great in theory, but you're probably thinking, how do I actually apply this? Perfect. Let's turn this entire concept into a dead simple, actionable checklist that you can use to filter every single trade, starting right now. So from now on, before you even think about hitting that buy or sell button, I want you to ask these 3 simple questions. Number 1, what's the trend? Check your compass, the moving averages. Number 2, what's the momentum? Check your fuel gauge, the RSI. Does it support the direction you want to go? And number 3, is there participation? Check your crowd meter, the volume. Is it confirming the strength? Now listen up, because this might be the most important rule of all. What happens if the indicators disagree? What if the trend is up, but volume is weak and the RSI is screaming overbought? The answer is simple. You wait, or you skip the trade entirely. Knowing when not to trade is one of the most powerful skills you can have. Skipping a low-quality setup isn't a failure, my friend. That's a strategic victory. Now, to really hammer this home, let's talk about the dark side. Let's look at what happens when traders ignore confluence. These are the most common traps, the ones that are just so easy to fall into when you're only looking at one signal. First up, we've got the falling knife catcher. This trader sees the RSI dip below 30 and they think, yes, it's oversold, it has to bounce now. But they completely ignore their compass, which is showing that the price is way below all the key moving averages. A strong downtrend couldn't care less about being oversold, it'll just keep on dropping. And of course, here's the flip side of that coin, the trader who tries to be a hero and call the top. They see the RSI is over 70 and they think this rally is done for, and they start shorting. But they're fighting a powerful uptrend with massive volume behind it. They're basically trying to stand in front of a freight train, and the market loves to punish those heroes. And finally, the fake out. Oh, this one gets so many people. The price smashes through a key resistance level. It looks so exciting. Everyone's getting ready to pop the champagne. But a quick glance at the crowd meter shows pathetic volume. There's no real conviction. This is the classic bull trap, a move that looks amazing for a minute and then just dies quietly because the big money never even showed up.
So let's just boil this whole thing down into one simple, powerful formula. It's not about predicting the future. It's about preparation. You take your trend, which you get from your compass, the moving averages. You add momentum from your fuel gauge, the RSI. And you add conviction from your crowd meter, the volume. That simple equation is your filter for finding smarter, higher probability entry.
I want to leave you with this one final thought. No indicator, not one, can predict the future. That's not their job. Their real power isn't in fortune-telling. It's in helping you diagnose what is happening in the market right now. So the question you should be asking yourself isn't what's going to happen next. It's, am I using these tools to see what's happening today with absolute clarity?